Hello, everyone, and thank you for joining us. My name is Laurel Page, and I am the Assistant Director of Events at the University of Colorado Boulder's Leeds School of Business. Welcome to our 8th webinar series. These continue to be trying times, and here at CU Boulder, we have gathered our world-renowned faculty and alumni to provide frank and timely insights. Today is the first of 6 webinars in this webinar series. To view upcoming webinars, please visit colorado.edu/business/alumni. Click the drop-down arrow and click Attend Online Webinars. For today's webinar, we're excited to welcome Sloan Speck, here presenting Tax Relief in the Pandemic Year 1. A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask Sloan, please send a question through the Q&A interface. We will monitor questions as they are submitted, and Sloan will respond to them at the end of the presentation. As a reminder, for optimum audio quality, we do have everyone on mute except for myself and our speaker. If you experience any technical difficulties during the webinar, please notify us through the chat interface and one of our support specialists will touch base. Lastly, a link to access the webinar recording will be sent to all registrants tomorrow, along with a survey link and supplemental resources from today's presentation. Now, I am excited to introduce today's speaker. Sloan Speck is Associate Professor of Law at the University of Colorado Law School. Professor Speck's research and interests are in tax law and policy, with an emphasis on corporate and international tax, legal and business history, and the ways in which taxation informs relationships between state and society. Before joining Colorado Law, Professor Speck taught at New York University School of Law and practiced in the Chicago office of Skadden, Arps, Slate, Marr & Flom, LLP. Professor Speck has a JD from the University of Chicago Law School and an LLM from New York University School of Law. Welcome, Sloan, and thank you so much for being here. I'm going to hand over the webinar controls to you now.
Thank you so much, Laurel, and thanks to all of the participants for coming today on a very wintry early spring day. So this talk is entitled Tax Relief in the Pandemic Year 1. And there are 2 topics that I'm going to talk about today. The first I'm going to call A Tale of Two Subsidies. And this will focus on the economic impact payments, the recovery rebates, the stimulus checks that people have received, as well as the tax side of federal unemployment benefits during the COVID-19 crisis. The second topic that I'll cover, I'm going to call Hot Takes on Tax 101, and that's riffing off of a quote from former Treasury Secretary Steve Mnuchin about this topic. But the topic is going to deal with the tax consequences of loans and their forgiveness under the Paycheck Protection Program, which was intended to support small business and to support employment during the early and now later stages of the current crisis. So a tale of two subsidies. The first subsidy are the COVID-19 recovery rebates, the stimulus checks that have gotten a lot of press and a lot of congressional attention and administrative attention as well during the COVID-19 crisis. These are originally were termed economic impact payments in the CARES Act, which was enacted just a little bit more than a year ago. They're currently recovery rebates under the most recent Biden stimulus legislation and under the Budget Act at the end of 2020. Basically, everybody else calls them recovery rebates, but there's a lot that the IRS has put out that deals with economic impact payments. Recovery rebates obviously have both political and kind of media-oriented appeal. Economic impact payments was just a terrible choice of words by the folks who were very rapidly drafting the CARES Act in the early stage of the coronavirus crisis. These recovery rebates they draw on an earlier kind of mechanism for getting money out to people during times of economic crisis. So the Bush II administration pushed for it and received from Congress recovery rebates in 2001. So at the end of the dot-com bubble burst, there were $300 to single people and $600 to joint filers, delivered by check, like a nice check from the IRS in the mail. 2008, at the beginning of the 2008-2009 financial crisis, kind of in advance of it, there was a sense there was going to need to be some stimulus. And so the Bush administration pushed forward and received similar $300 to $600, $600 to $1,200 for joint filer recovery rebates. So the CARES Act, and then the other two rounds of legislation that I'll talk about, used a similar kind of strategy. Just give money to people during a time of crisis. They need the money. They're going to spend the money. It's going to help the economy. This is overall a thing that might be useful to do in a crisis. So the CARES Act, the recovery rebates were significantly larger than the Bush years. So $1,200 for a single person, $2,400 for a joint filers, with an extra amount per child. It's not per dependent. It was, if you were older than 17, you got booted out of that particular category for that round. Then at the end of last year, in December of 2020, Congress enacted the second round of recovery rebates, half the size of the first round, but with a bigger kicker per child. Then round three, just a few weeks ago, or I guess about a month and a day ago, the American Rescue Plan, so the Biden administration's first cut at its kind of legislative agenda, put out really significant recovery rebates. So $1,400 and $2,800 to individuals, and $1,400 per dependent. And this change from child to dependent got a lot of play in the media. One thing that it did was to draw dependent college students back into the stimulus payment world. So folks who are under the age of 24, dependents on their parents' tax returns, full-time students, they got $1,400, or their parents got $1,400 in this third round of recovery rebates. There are some limitations to these. So there's a phase out on all three rounds at $75,000 or $150,000, depending whether you're filing single or joint. And the phase out ended relatively quickly. So there was a point at which there was no recovery rebate if you made over the amounts on the slide. Note that those phase outs are tighter and tighter over time. So Congress has been less generous for folks who are over the 75, 150 threshold for these successive rounds. What was a recovery rebate? Well, technically it's an advanced refundable credit with respect to one's taxable income, either in 2020 for rounds 1 and 2 or 2021 for round 3. And it's based on 2018, 19, or 20 taxable income, or for rounds 1 and 2, 2019 Social Security benefits. So it's based on a retrospective amount for the current check that's being paid out, but it technically applies to your kind of future income tax return. So there is a true up on folks who have filed for this cycle or who are filing in the next month or asking for extensions. If you received a recovery rebate or an economic impact payment, but you didn't get as much as you were entitled to, or you would be entitled to more now that you know your 2020 income. There's a kind of an increase ability on kind of your current year filings. This is the recovery rebate credit. There's no clawback. So if your 2020 income reveals that you should not have received an economic impact payment or a recovery rebate, that doesn't get taken back by the federal government. That just stays out there. So there's no clawback, but there is a possibility of increase. All right, budget estimates. So how much is all this going to cost? Well, rounds 1 and 2, 300 billion, 150 billion-ish, 400 billion for round 3. Recall those amounts are substantially higher in the Biden administration's first cut at coronavirus relief. Total $878 billion. So a big chunk of money being pushed out the door to individuals through the recovery rebate process. Well, that's not all that Congress was doing to help individuals during the pandemic, not by a long shot. Another big prong of relief was enhanced unemployment benefits that were supported by the federal government. And these there's a lot of different avenues through which the federal government is pushing money out to the states and to individuals to try and get them through the coronavirus crisis. I'm going to focus on federal pandemic unemployment compensation, but that's a big chunk of this picture. But there's a bunch of other stuff as well that's going on there. So essentially what this was a $600 per week bump for the early parts of the pandemic, the early phase of the pandemic, and then $300 a week kind of thereafter. There was some administrative work by the Trump administration to meet that $300 per week amount. There's been congressional work to extend these unemployment benefits. There's a lot like more texture to this than I'm giving, but this is a rough cut about kind of what these look like. The enhanced unemployment for COVID relief also expanded coverage from the kind of standard 26 weeks to up to 79 weeks after the most recent round of legislation. And also coverage was expanded to certain self-employed individuals. So this is, again, a big program that's reaching really far. So one question is, well, why talk about this in the tax talk? Well, there's a lot of action in the most recent round of relief. So this is the American Rescue Plan Act enacted by the Biden administration in early March, signed into law for taxable years that begin in 2020. So this is going to be a lot of the pandemic for most people. So all of 2020 for calendar year taxpayers. This Biden relief plan excluded unemployment compensation from income. And that historically has not been true. It's in the Internal Revenue Code, and historically courts have included unemployment compensation in folks' income. So you get unemployment benefits and you're taxable on those unemployment benefits. So the American Rescue Plan Act excluded unemployment compensation in 2020 from folks' income. There was a cap, so you can only exclude up to $10,200 from your income. Each spouse, if you file jointly, got to exclude that amount. And then there's a limitation based on adjusted gross income that's modified in certain ways. But basically, if your household earned less than $150,000, you could take advantage of this tax exclusion. It's calculated excluding unemployment benefits, which opens this exclusion up to more people. So the tax side of the house for enhanced unemployment is not so much the $300 per week or the $600 per week. That's operating through state unemployment. But there is this kind of tax quirk that you're not taxable as you would have been in prior crises on the amounts received up to $10,200. This has kind of weird effects. So I'm going to call these collateral consequences. And this kicker, this additional benefit that Congress put into place a month ago, the benefits of this kicker vary by people's tax rate. So if you are taxable at 10% or 12%, not unreasonable for single individuals or joint filers under $150,000, kind of joint up to about $80,000 is taxable at 12%. You get about $1,000 back from the IRS if you had taxable income and paid tax in 2020. So you get up to $1,200 back in addition to the unemployment benefits that you receive, the enhanced unemployment. And then for folks who are kind of at the higher end of that $150,000 limitation, their marginal rates are higher and their tax benefits are higher, double more or less what the folks at the lower end of the spectrum might be receiving. So maybe $2,000 to $2,500 back in their pockets potentially if they were unemployed and got these unemployment benefits in 2020. So this is it's implicit. This is tax they would otherwise need to pay. That's kind of being relieved through this congressional change. And I want to note that it provides bigger benefits for folks who are at the higher end, really close to $150,000 cap. Smaller benefits for people in the middle. And then it has kind of idiosyncratic, like very weird effects at the lower end where you start having interactions with the earned income tax credit and other things. So it's this very odd way of getting money in people's pockets, not as linear as flat amount per week if you're unemployed and claiming unemployment benefits, not as linear as the economic impact payments or recovery rebates, just a fixed amount with a very small phase out zone. So this variance with marginal tax rates, Stanley Surrey, the great tax lawyer of the second half of the 20th century, described this as an upside down subsidy. People who are doing better get more, in effect. People who are doing worse get less. And that seemed to him to be unfair. So the collateral consequences, you can think of this as a tension between the background rule for unemployment compensation, which is that unemployment is a substitute for earnings one would otherwise have. If you're taxable on those earnings, you should be taxable on that unemployment benefit. So you're going to give this as like an origin of the claim kind of idea. If the unemployment comes in because you're not working, well, how would you be taxed if you were working? You would be taxable on that income, so they're both included. There's another doctrine that's kind of competing, which is it's known as the general welfare doctrine, and its kind of broadest statement is that means-tested government transfers are not taxable income. They're just payments from the state that don't fall under kind of a judicial analysis in taxable income. So the kind of current rule for 2020 is a more general welfare idea of what unemployment looks like. And that's a stark contrast to the way we've dealt with unemployment for folks, for individuals in the past. So budget estimates for unemployment benefits, this is not the tax side of the house, this is just the $300, $600 amounts. So CARES Act, 250 billion, Consolidated Appropriations Act, 115 more or less, American Rescue Plan, 155, so a total of 593 billion. Not as much as the recovery rebates, but a pretty substantial chunk of money to be pushing out into people's pockets during a time of crisis. Well, why should we make these payments? What are the reasons for doing these kinds of transfers from the government to individuals? Well, one reason might be that folks need emergency funds. And so this is a way of getting money in their pocket so they have money to tide them through a temporary crisis. And the unemployment amounts, the 300 and 600, seem to clearly correlate to this kind of an idea. Less clear that the tax benefits also flow from this idea. We're still in a crisis. Folks are filing their 2020 tax returns now or in the recent past or in the near future. So they may still need emergency funds, and this may reflect that sense of emergency. The economic impact payments, this is actually a kind of an interesting success story that I think was, for me, fairly unexpected. If you're cutting checks to people, putting money in their pockets, and you need to get it to them because it's an emergency, you want it to go out pretty fast. The CARES Act was signed in March of last year. By the end of August, 92% of the projected amount of money to be sent out in these economic impact payments, 92% of those funds were pushed out the door. And this was a really big success story in kind of getting money out as quickly as possible. It had not been done in this way before. This very rapid rollout of the economic impact payment program really did support a kind of economic or emergency fund idea of these types of transfers. However, there was a chunk of folks who got kind of left behind in this process. So as of January of 2021, there was an estimated 8 million people who had not received their economic impact payments from the preceding March's CARES Act. And the Biden administration made a big push to try and identify those folks, and hopefully has been able to do some of that. We will know in the future whether they've all been reached. But I do want to note that if you care about emergency funds, this might be a problem. If you can't reach 8 million people, that's a large number of folks who are just not getting the emergency money that they need. Again, one more data point on kind of how quickly all of this happened. The Bush 2 recovery rebates, the first payments in 2001 were 6 months after the legislation was signed into law. 2008, 3 months. Round 1, 3 weeks until the first payments went out, and less than a month to get more than half. Round two, all payments were made in 20 days. Anything in excess of, or any other payments that were not pushed out in 20 days, those were rolled into the 2020 tax return for people. Round three, first payments out in 6 days. So this process has gotten even faster as kind of time has gone on. And it's a big change from prior experience with recovery rebates. In large part, this is due to Treasury. So Treasury really made a coordinated effort to get money out the door as quickly as possible in as many vehicles, through as many vehicles as possible. And there were speed bumps. TurboTax would set up dummy accounts for people who filed through it. If they chose to pay their fees to TurboTax from their refund. Sometimes those dummy accounts got the recovery rebate, not the actual individual who filed their return. There were other kind of hiccups along those lines. Treasury did reach a lot of people and was able to fix a lot of mistakes later. Congress was able to fix others involving like payments to people who had previously deceased. And there was a bunch of coordination between Treasury and the Social Security Administration that really I don't want to undersell. This kind of cross-agency coordination is a big deal and something that has been thought to be pretty difficult to do in the past. So like it worked and it was kind of surprising. Like the lightning hit the car and it went back in time and everybody was saved. Nobody disappeared. But there are some caveats, right? So did it really work? Well, it was hard to reach non-filers. So you've got 8 million people who didn't get their payments after almost a year, after 10 months. Non-filers are a part of that. The unbanked or the underbanked also had a hard time getting their payments. The people who are most vulnerable, those 8 million folks who were very hard to identify, those folks may have needed that money the most. And so if we're not reaching those people, that's not a good thing. Completeness. And then kind of repetition and durability. So we've done 3 rounds of stimulus payments so far. And maybe this is the end, or maybe it's not. Repetition improved kind of the rollout of these programs through the different rounds. But there's a question about durability. This is not going to be the last crisis that our country faces, and probably not the last time we consider cutting checks to individuals as a result of the crisis. So will these mechanisms be durable? Will they be able to be rolled out again with similarly quick results? Or will there be a slowdown on the next, for the next crisis and the next round of these types of payments? So another reason to make these types of transfers, to make economic impact payments, demand stimulus. After the Bush 1 recovery rebates, there was a Futurama episode where the main character gets $300 back from the government and goes out and buys 300 cups of coffee, I guess for $1 each, which seems somewhat unrealistic at this point. But the effect is that all of that money is being pushed back into the economy, is being used to buy goods and services and to kind of stimulate the economy in a time of economic contraction. So if that's a reason for making these types of transfers, the unemployment benefits, the stimulus checks, we kind of need to know where this money is going, what people are using it for. And there are really 3 different things that folks can use this money for. They can spend it, they can buy the cups of coffee, they can pay down debt, which is essentially a form of saving, which is the 3rd thing that they can do. So you can spend it, you can save it, you can pay down debt, which is kind of like saving. It's reducing your negative net worth, moving it closer to 0. This is kind of like the old adage about throwing passes in football. So 3 things can happen and 2 of them are bad. Saving and repaying debt, not going to stimulate the economy. Spending will. Just to give a point of contrast, food stamps, prior to this crisis, it was estimated that $1 of food stamps generated $1.73 of spending throughout the economy. Cutting checks to everybody, $1 generates 20 cents of spending historically. But this changed based on kind of preliminary evidence from this current crisis. For round 1 economic impact payments, 74% of people said they used that money to pay expenses. Only 14% said they repaid debt, mostly repaid debt, and 11% said they mostly saved it. Some of that 74% also repaid debt or saved. So this is just mostly, it's not 100%. But it's a lot of, this does reflect kind of an idea that people needed this money to survive through the early stage of the COVID-19 crisis. Okay, so we're going to also look at these types of transfers in terms of how they affect GDP. So that's another way of looking at whether we are stimulating demand and kind of jumpstarting the economy with this type of money. So unemployment produces a 67-cent GDP increase per dollar of unemployment benefits. These kind of checks to everyone, 60 cents on the dollar. One thing that gives an even higher benefit, transfers to state and local governments. There was $350 billion worth of this in the American Recovery Plan Act. That has a huge return on investment in terms of GDP effects. Paycheck Protection Program estimated to be 36 cents on the dollar. We'll turn to that in just a second, but I did want to show that contrast in terms of how these different programs presumably affect the overall economy. A final reason for kind of making these payments is that they're actually a form of progressive redistribution. So there's kind of another value at play that you may or may not subscribe to. But the economic impacts, for example, it's a fixed amount with a phase out. This has the effect of funneling the cash towards folks who are, kind of moderate, low to moderate to kind of high moderate earners. But it's progressive. It's a progressive transfer. The same with unemployment, presumably. Folks who are claiming unemployment benefits are also those who are going to be more deserving in a progressive redistribution type system. The question of goes back to kind of who are we not reaching, and do those people need it more? And that may well be true. A final reason for making these transfers is politics. You might remember that there was a question about whether Trump's signature could appear on any physical checks that were cut for the economic impact payments under the CARES Act. That was not permitted, but there was a letter sent with Trump's signature to any recipients that just reinforced that this money was coming from the government and maybe one politician in particular. Similarly, on the other side of the aisle, Andrew Yang's support of basic income type principles, these economic impact payments, these types of transfers, they are consistent with the idea of a universal basic income, and maybe signal kind of a recognition on the left of these policies as being worth exploring. So there are political valences on kind of both sides that relate to these types of payments. All right, finally, just to kind of talk about revenue. And I'll put a question mark because these are obviously things that are negative in terms of their revenue effects, at least for the current kind of time period. So I've got a chart that shows the federal debt through the end of 2019. It's a lot of money, but there's a big bump between the end of 2019 and the end of the third quarter in 2020. A lot of that is the stimulus efforts during the COVID-19 crisis, as well as a fall off in receipts during that crisis and a deferral of receipts during that crisis. But this stuff is expensive, and it's being financed through borrowings. Herbert Stein, the conservative economist, said that if something cannot go on forever, it will stop. He was, of course, referencing federal borrowings in a period much earlier than our current period. Whether you think that's right is something that's open to debate and is very much an open issue kind of among economists right now. Herbert Stein was also an advice columnist for Slate magazine. He said, one cure for unrequited love is requited love. There are other cures also, such as devotion to the study of the Finnish language. So maybe if that's good advice to you, the federal debt's worth worrying about. There are folks who would probably dissent from this advice and also from his thoughts on debt. All right, next topic, hot takes on Tax 101. So this is about the Paycheck Protection Program. And the Paycheck Protection Program is a small business administration program that is meant to give loans to businesses to help keep their workforce employed during the shutdowns in particular of last spring, but also throughout the COVID-19 crisis. There's a lot of kind of money in this program. So it started with 349 billion, but it's been increased to more than 800 billion or almost 800 billion through kind of the end of last year. Then there's a little bit more that was added along with some modifications to the program requirements in the Biden administration's legislation from a month ago. So the Paycheck Protection Program, these are sometimes referred to as groans, which is a kind of a combination of grants and loans. So these are loans to help businesses keep their workforce employed, but they convert to grants. So you can also call them lance. That means they're loans that turn into grants. Maybe that's a better name than groans. It certainly elicits fewer of them when you say it. The Paycheck Protection Program groans or lance, these loans converted to grants if they were used for certain purposes. So payroll and benefits, help keep your workforce employed, but also other stuff, interest, rent, utilities, certain of those expenses were also permitted uses. Then at the end of last year, those uses were expanded to include a bunch of kind of throw-in items that maybe reflect some special interest advocacy, as well as the completely reasonable category of anything that helps protect your workforce against COVID-19. So all of the expensive precautionary measures, those are also allowable uses. Basically, at the end of the day, 60% of the funds have to be used for employees and 40% are like slush. And that's been reduced from the original 75%, 25% ratio. So Paycheck Protection Program, the question is like, what are the tax consequences of these groans, of these lance, of these loans they're converting to grants? And under the usual rules for debt in our income tax system, if you borrow, you don't have income. You get cash in your pocket, but you have no income currently. But there is an expectation that you will pay back that loan amount, the cash you got in your pocket, with money that you earn from other sources that you've paid tax on. So you pay that loan back with after-tax dollars. So for example, a business borrows $60,000, earns $80,000 after expenses, pays $20,000 in tax at a 25% rate, and pays back the loan. That's kind of how this system usually is supposed to work. Well, it doesn't always work that way. Sometimes the loans get forgiven, they get canceled because the borrower can't pay or is not in financial straits or something similar. So if I'm borrowing, you have cash and no income, the forgiveness actually does create income. Any amount of the loan that's forgiven, that's taxable income under the conventional tax rules. So the same example, if the $60,000 loan is forgiven, there's $60,000 of income, and that might require a $15,000 tax payment if you're taxable at 25%. All right, there are exclusions that apply. There are ways to defer that tax cost for loan forgiveness, but those are kind of special regimes that have a bunch of technical requirements to get into them. Now, the Paycheck Protection Program, in the enabling legislation in the CARES Act, very clearly Congress said that forgiveness of PPP loans does not result in taxable income. But Congress was silent on what I'll call the collateral consequences of these borrowings. And Treasury was quick to weigh in. So the IRS issued a notice in about a month after the CARES Act in 2020 that said, if you use your loan to pay for expenses for your business that would otherwise be deductible, if that loan is going to be forgiven, if you think it's going to be forgiven, you can't deduct those expenses. So if you borrow and your loan is forgiven, you have no income as a result of the forgiveness. You also don't get a deduction for whatever you use that money for. So for example, so for all of the allowable uses, basically those will all be deductible. Payroll, benefits, interest, rent, utilities, those would be deductible expenses, and Treasury says those are no longer deductible. So for example, business borrows $60,000 to the Paycheck Protection Program, pays expenses that would usually be deductible, but their PPP loan is forgiven. They have no income from forgiveness. That's different from the usual tax rules. They also don't get to deduct the $60,000 of expenses they paid for. Also different from the usual tax rules. And you can kind of, so if you have no income and no expenses, and there's no consequence, but you can kind of see how this might, you have no tax, how this might harm a business or be perceived to harm a business if the business actually still has income after paying all of these expenses. If there's still $60,000 of income, and there's no deduction for the $60,000 of expenses, there's going to be a $15,000 tax hit that the company is going to take, the loan recipient is going to take. When this position that the Treasury took became clear, there was like a minor revolt among borrowers and tax advisors who were like, this isn't fair. Like, this is a tax cost that our clients weren't expecting, that we didn't think was going to happen. This is not doing what Congress intended. And Steve Mnuchin said, if you get money that's not taxable, you can't double dip and take a deduction for expenses you pay with that money. That's basically tax 101. If you don't have income, you can't also deduct expenses that you pay with that cash. Well, not everybody agreed. So 3 of the 4 folks who were involved in the Senate Finance Committee, or leading the Senate Finance Committee and the House Ways and Means Committee, said, no, this is not consistent with congressional intent. Kevin Brady, the ranking member of the Ways and Means Committee, was silent, obviously did not think that. And Treasury actually doubled down. So in November, it said, look, actually, we were serious about this. You guys may have sent us some letters. There's been a lot of negative press, but yeah, you don't get to deduct expenses paid with PPP loans. Congress struck back, and on the budget bill at the end of last December allowed deductions for expenses paid with forgiven PPP loans, and actually extended this context to this concept to a number of other contexts as well. So this idea of a forgivable loan that's excluded from income, but also allow kind of an allowance to deduct expenses paid with that money. This theme was iterated a number of times in a number of contexts throughout the December budget bill. And then I guess reiterated a month ago with Biden's first stimulus and the unemployment stuff. So for example, just to show the effects of this, you borrow money through PPP, you pay expenses, the loan's forgiven. There's no income, but you might have other income of $60,000. You can deduct those expenses and you will pay no tax. Similarly, if you have no income, you might be able to deduct those expenses, carry back your net operating loss under CARES Act modifications to those rules, and claim a tax refund of $15,000. It's like extra money in one's pocket, this idea of deductibility coupled with exclusion of the loan forgiveness. So that's where Congress kind of left things. And so the question I want to ask is like, well, what's wrong with a double dip? This gives the benefit of having the exclusion from income. You also get the benefit of taking deductions under the current rules. But what's wrong with that? Especially if it's consistent with congressional intent. Well, it might be an upside down subsidy because as we'll see, the benefits vary with people's tax rates. It also might be a challenge or might challenge some of the control that Congress has tried to exercise over the use of these funds. And finally, it might be a persistent design choice that will be reiterated in other contexts or in similar revivals of this program for future crises. And this may not be the best possible design of a program that we might come to when given enough space and time and an absence of politics or something like that to come up with something. So upside down subsidy. If you have a $60,000 deduction, your tax benefit from that deduction depends on the tax rate you pay. If you don't pay tax at all, you get no benefit from a deduction. So nonprofits, for example, doesn't really make a difference for them. If you're taxable at 25%, you get a $15,000 benefit. 21%, like corporations, are a $21,000 benefit. So one's benefit varies with one's tax rate. And if you earn more in a progressive tax system, you get a bigger benefit. So this is an upside down subsidy. And maybe this is a reason to not be so friendly towards this particular rule, which admittedly has a lot of political valence and value. Another reason is control. The Paycheck Protection Program is meant to support keeping people paid, employees on the payroll and getting their paychecks during a time when it's hard for businesses to keep operating. So the allowable uses is a very, very specific statutory mechanism to control how this money is being spent. A tax refund, do whatever you want to with it. Go on vacation, pay it out to shareholders. That tax benefit component of the Paycheck Protection Program is unrestricted in a way that the other funds are not. So you can think of the Paycheck Protection Program as being a restricted grant equal to the loan amount, plus a smaller unrestricted grant that's based on the borrower's marginal tax rate. Different for different people, bigger if you earn more. All right, so design choice. So this is kind of a tension between democratic deliberation and making good policy choices versus just getting cash out the door in a time of crisis. And I think the critical thing here is to just note that these types of programs tend to be reiterated both for extended crises like the one that we're currently in, but also for future crises. When we looked in the future for different relief mechanisms, the Paycheck Protection Program is one that will probably get floated, and it will have this tax feature that may or may not have good policy effects. So I want to just talk about kind of another or a set of menu options that one might look at when evaluating this policy. The world we're in right now, if you think of the Paycheck Protection Program's tax aspects as having kind of two dimensions, either you deduct or you can't deduct the expenses paid with that loan that converts to a grant, and you either include or you don't include those loan proceeds on their forgiveness and income. You can have a world where you have no inclusion and no deduction. That's what we initially had when Treasury first produced guidance under the CARES Act. And that world's actually very close to having an inclusion and a deduction. Maybe worse for taxpayers. Under this kind of opposite but very similar type of regime, folks could deduct expenses in 2020 and then maybe they have income in 2021. There might be a timing benefit to this kind of opposite mechanism. A menu item that was not, I don't think, considered very seriously by the CARES Act drafters. And then you've got the no inclusion deduction regime that we have currently. So this is what Congress enacted in December of 2020. That's another menu choice, but that's not all of what one could choose. There is a fourth view of this problem. You could include the forgiveness of loans and income, and then deny deductions for any expenses paid with those loans. You can think of this as being like a double detriment. So taxpayers are taxable on this kind of grant money that's being given to them. And they also can't deduct expenses that relate to payments made by that grant. So for example, business borrows $60,000, pays $60,000 expenses, has the loan forgiven. It has $60,000 of income as a result of the forgiveness. It has no deductions for those expenses, and it pays tax of $15,000. The net grant is $45,000 instead of $60,000, and the taxpayer is out of pocket for $15,000. You can modify this in different ways to kind of take some of the sting out of this double detriment scheme. But the effect is that it's a restricted grant equal to the loan amount kind of reduced by the borrower's marginal tax rate. So it's a lower grant, but there actually are more controls on what that money is used for. So the entire $60,000 is subject to restrictions, even though in effect the taxpayer is kicking in 25% or $15,000. So this would give potentially enhanced control. It would also be progressive because the higher your tax rate was, the bigger the detriment of not deducting expenses, the bigger of a kind of copay that business has with respect to its Paycheck Protection Program loan. So this is like kind of the road not taken for very obvious political reasons and probably for intuitive reasons. But to foreclose all of these, this fourth perspective, or the other three other than the no inclusion and deduction paradigm, is maybe a mistake. At the very least, ought to be thought through very carefully. You could come up with a mechanism of the double detriment scenario where you give grants to needy businesses that can't afford that tax copay. And that might be a better solution than just kind of giving double benefits to everyone. The big issue in this area has become kind of whether states should conform their taxes to match the federal kind of double benefit scheme. So most states are on board with the no inclusion part, but there's a question about whether states should allow expense deductions that Congress put into place last December. And that's kind of varied a lot across states. Colorado allows them up to a certain cap. It's an area where you get some of this, some more texture, some more menu options with regard to this kind of arcane tax issue. All right, in conclusion, There are a lot of ways of looking at tax policy, and the traditional ones for tax policy people are equity. Is the system fair to people? Efficiency. How does our tax system affect kind of the market and economics? And simplicity. Can folks understand and easily get through all of the tax questions they have? You might also value things like revenue and social policy, which is often implemented through the tax system. The question is, in a time of crisis, like the COVID-19 crisis, how do we evaluate the kind of tax relief that I've just talked about and that Congress will consider, or has considered and probably will consider in the remainder of this year? And there might be some other norms that are important. Individual versus systemic concerns. Should we care about economic stimulus or about keeping people solvent through a crisis? Temporary versus permanent changes. Are we making kind of one-time exceptions for certain situations, or are there some permanent changes that we ought to make to our tax system? Speed versus accuracy. So getting payments out to people, getting PPP loans to those who really need them. There's a tension in a crisis between doing it quickly and giving those benefits to the right people. And finally, institutional capacities. We've seen a lot from IRS and Treasury that have shown a kind of more capacity maybe than they historically have shown. But these institutional capacities are really important in terms of picking and choosing which relief measures one uses. Thank you, and I'm happy to take your questions.
Thank you, Sloan. As a reminder, if you have any questions, please submit them through the Q&A interface located at the bottom of your screen. Our first question is, are any relief funds taxable to the recipient? If so, which are subject to taxes?
Unemployment benefits received in 2021, if you're a calendar year taxpayer, those are going to be taxable. PPP loans that don't convert to grants, those you'll have to repay them with taxable income. It's a good interest rate, and the loan terms are quite favorable, but there essentially is a tax detriment to trying to repay those loans from a certain perspective, at least. The larger trend has been for Congress to expand this kind of non-taxable category. So economic impact payments, those are framed as refunds of taxes that would be due in 2020 and 2021. And that framing is actually intended to make them non-taxable to recipients. They happen entirely after you've paid tax. They don't generate more tax to be paid. The same for PPP loans at this point, is that they exist in like a separate category. They have double tax benefits as opposed to some other treatment. Those would have been taxable, and for up through December, people thought there was a tax detriment to those types of loans, but that's gone across a number of categories kind of in recent legislation.
Thank you, Sloan. Our next question is, how do these stimulus checks end, as we can't forever give out handouts?
Mm-hmm. So, it's interesting because this is like the politics prong of the kind of economic impact payment recovery rebate question. This type of cash transfer to folks, no Republican is going to vote for whatever Biden wants to do next, especially in the Senate. But this is not the least palatable of the Biden administration's proposals to folks who are on the right. And certainly it was an easy go-to mechanism that got bipartisan support in the CARES Act and then the budget bill at the end of 2020. So these mechanisms are likely to be revisited. There are probably some on the left who would like to expand them and make them more regular and transform them to some kind of basic income. But that's not going to be the entire left. So the stimulus checks, there might be another round depending on how the crisis unfolds, or this might be it. They certainly will be floated again as a bipartisan idea in future crises. So I don't think we're going to see an end. And can we forever give out handouts? I mean, I don't think anyone knows the answer to that question. We probably won't know until we make a mistake and figure out that we cannot do that forever. So that's the Stein point. In terms of I guess, transfers that are potentially longer term and more durable. So the expansion of the earned income tax credit and the child tax credit, those are a big deal and a step towards, I guess, handouts, but transfer payments in respect of poverty or having kids, that probably will be more persistent, those changes, those expansions and restructurings.
Thank you, Sloan. Our next question is, since student loans did not have to be paid back during this time, if you paid interest on the loans, will this still be able to be deducted from taxes?
It's going to depend entirely on like what your earnings are and whether you're otherwise able to deduct the interest. But I think the answer is, and I don't know this for sure, I'd have to actually like look. But you know, the usual rule should apply if you've paid interest. So I think that's my answer for that.
Thank you, Sloan. Our next question comes from Alan. Are there any state tax authorities doing something different for a taxing perspective than what is occurring at the federal level?
Yeah, this is a huge issue. So this is probably, I would say this is probably the biggest like open question coming from a policy perspective, from a legal perspective right now is, and this has been a question that's been open since the Republicans' major legislation during the Trump administration, the Tax Cuts and Jobs Act in December of 2017. So that law changed a bunch of tax rules. States, I think all states, use the federal income tax base as a starting point if they have an income tax. So states are leveraging the federal rules to create their own income tax systems for convenience, for ease of administration, to avoid irate citizens. They will modify that federal income tax system to more appropriately reflect their values and the revenue needs the state has and the way that the state wants to allocate those burdens to its citizens, or folks who are taxable by it. This has been a big deal for several years now, how far along the road to tax cuts should states go? How much revenue should they sacrifice if the federal government is willing to sacrifice revenue? And states are under different constraints. They typically are required to do more budget balancing, or they have tax increase restrictions like we do in Colorado or in California. So they operate in a very constrained tax system and a very constrained borrowing system that the federal government just doesn't face. So this question of whether states should give the same tax benefits the federal government does, this is a big deal. And for the Paycheck Protection Program, as I mentioned, conformity is the big issue right now. After December, when Congress said, yes, you get to deduct expenses paid with your Paycheck Protection Program loans, states were faced with the question of whether they also ought to allow those expenses and take the revenue hit that those expenses would generate. And the answer seems to, the dominant answer seems to be kind of like partially. So businesses that are smaller, that have lower earnings, they're able to deduct some of these expenses, but larger businesses that got PPP loans, they're stuck under the old regime.
Thank you, Sloan. Our next question is, how will the recent $2 trillion stimulus package and the $2 trillion infrastructure plan affect the middle class?
So this is a great question, and some of it depends on what you mean by middle class. There is a fair amount of relief that I think is middle class directed. So the recovery rebates certainly are, and those one way of viewing them is that they're a way of getting middle class support and buy-in to a package that includes a broader range of reforms. The most recent stimulus package really upped the ante in terms of dollar amount for those recovery rebates. And a lot of that money is going to benefit people who are in the middle class by whatever definition you use. There are other things. The child tax credit is one that will have a lot of middle class benefits. And the middle class has not been unaffected by the economics of COVID. So the unemployment benefits also have a middle class component as well. You can think of any of the upside down subsidy parts of what I've talked about as being something that provides a greater benefit to the middle class than the people who are earning less money. So I think like these packages do affect the middle class, and maybe more broadly. So for stuff like the infrastructure plan, that's going to generate a whole bunch of government spending that may have positive effects on the middle class, or may trigger tons of inflation that has a hugely negative effect. The tax stuff in Biden's plan, I think, is worth like talking about really briefly, and so I did prepare a slide on it in case this came up. So the infrastructure plan that Biden has floated has a companion tax plan that's called the Made in America tax plan. So, and the components of this are still pretty vague, so it's not clear exactly what this plan is going to look like. But broadly speaking, there would be an increase in the corporate rate from 21% to 28%. So you can think of us as being 25% is more or less the kind of global developed country average for corporate tax rates. So we're kind of low right now. We were much higher, 35%. And so we'll go back to being a few points above at 28%. There's a global minimum tax, which is complex, but it was enacted by the Trump administration in 2017 and would be doubled essentially to under the Biden administration. So this is kind of a weird instance of Democrats using a Republican idea to raise revenue and to impose kind of a stronger tax obligation on people who have multinationals who historically have avoided tax in complex ways. So that's another piece of this plan, but that would be on the corporate side and affect multinationals. Minimum tax on corporate book income, this idea has been around for a long time, the idea of book tax conformity. This is kind of an interesting implementation of it that folks have thought about for a while. There are a bunch of tax incentives and increased enforcement, which will almost certainly affect high income people and corporate taxpayers and not the middle class. So this, the infrastructure plan, the pay-fors are going to be almost entirely corporate and high earner. There are a bunch of questions that are outstanding. So what happens with existing incentives or guardrails? There are a bunch of revenue raisers from the Republicans' tax plan, Tax Cuts and Jobs Act in 2017. No idea what's going to happen to those yet. What will happen to pass-through businesses and the pass-through deduction or Section 199 Cap A? Not clear what's going to happen there either, although it seems reasonable to expect something to happen there. And then kind of the Joe Manchin problem, like, how do you get this thing through the Senate? What will have to change in those first 5 bullet points to get it past the 50th vote for Democrats? So that's just a quick overview of the Biden, the inchoate Biden proposals at present.
Thank you, Sloan. Our last question comes from Cruz. Thoughts on America moving jobs overshore due to corporate tax rate increases?
So, at least on the tax side, I'm not sure empirically how much offshoring of jobs is actually tax driven. So if you get those jobs in the US and your tax rate goes up, you can deduct the cost of paying your people. And so your tax benefit actually goes up. So that might cut against an idea of higher corporate taxes, meaning you have to like offshore your employees. If you have a higher global minimum tax at 21%, moving stuff overseas because you can like shelter it in some way from the US tax system, if that minimum tax is actually pretty good, then it's going to make that shifting less valuable. So raising the corporate tax rate, increasing the global minimum tax, those may or may not affect kind of jobs in the US. And I think that the best view is that non-tax stuff tends to have a bigger impact on the offshoring of jobs. One thing that it will do is it will, for the second time in 4 years, or 5 years, I guess whenever this legislation comes into play, it'll really shake up the international tax world, international tax planning. And that has like kind of crazy distributional effects because a lot of businesses do international work, but not a lot of businesses can afford the most expensive attorneys and the most expensive accountants to get the best tax advice. So having to reconfigure your entire system to reflect whatever the current tax rules are, and then have those change after 5 years, that's a huge burden that businesses will bear. And that readjustment is going to have some winners and losers if the Biden tax proposals get put into place.
Thank you, Sloan. And thanks so much to everyone for joining us for today's presentation. Again, thank you to Sloan for his great information. At this time, we invite you to provide your feedback on the webinar by answering the following poll question. On a scale from 1 to 10, how likely are you to recommend this webinar to a friend or other CU Boulder alumni? We thank you in advance for submitting your feedback. As a reminder, all webinar attendees will receive an email tomorrow with a link to the recording of this presentation as well as a survey. To view upcoming webinars as well as previous recordings, please visit our website at www.colorado.edu/business/alumni. We hope you will join us for our next webinar, which is tomorrow, as Dr. Anna Blinkley presents on self-amplifying RNA vaccine for prevention of COVID-19. In the meantime, have a great rest of your day. Thank you for your time, and go Buffs.